Inflation slowed more than economists had expected in February, falling from 5.9% to 5.2%. Still, the Bank of Canada has a long way to go to get inflation to its target, which is, of course, 2%. Randall Bartlett is a senior director of Canadian economics at Desjardins and joins us now. Thanks so much for making time today, Randall.
Thanks so much for having me.
So how relieved do you think the Bank of Canada is today after seeing inflation come in lower than expected, especially after the central bank decided to pause its rate hiking at its most recent meeting?
I'm sure the Bank of Canada is very pleased to see this. We've had, some data come in on the strong side since the beginning of the year, thinking about employment, manufacturing, retail, that sort of thing. And so, seeing inflation moving in the right direction is really, I think, one of the key indicators that the bank needs to, feel some relief that it's the prolonged pause that it's decided to take is really moving in the right direction, and that interest rates are really acting in the way they need to bring down the domestic drivers of inflation.
I am curious, though, how much do you think the Bank of Canada has actually played a role in the deceleration that we've seen so far versus other global factors? I mean, we were talking about the price of oil at the top of the hour and just how much it's come down over the past year. How much does that play into it versus the central bank itself?
There's no question that global factors are a big driver of what we saw today and what we're seeing just generally in terms of the trend of inflation. I mean, oil prices or energy prices were a drag on year-over-year real GDP growth for the first time in well over a year. And so that's something that, is helping the Bank of Canada out and providing a tailwind. But at the same time, we're seeing that core inflation is still remaining pretty sticky on a year-over-year basis. I mean, it came down to 4.8% from 4.9%, but it's still, much higher than it needs to be. And it's not seeing this sort of pace of deceleration that I think the Bank of Canada would like to see. We look at a broad group of metrics, whether it's the Bank of Canada's three core measures that it uses, technical measures, trim, median, and common, or we use the exclusionary measures of core that take out energy prices and food. I mean, all of those were broadly unchanged in the month. So it certainly suggests that, core inflation is sticking around at a higher level than the Bank of Canada might like to see. And so the bank, is going to need to keep rates high for a while, for the foreseeable future, just in order to make sure that it is weighing on economic activity and ultimately drivers of core inflation, particularly services. Are
you hopeful that the bank is going to, be able to chip away at that core inflation?
Yeah, we are optimistic that the Bank of Canada is going to be able to chip away at that. I mean, services are a big part of what's keeping inflation elevated. And, part of that story is shelter. And we're seeing that obviously home prices are coming down. That's pulling down homeowners' replacement costs. But mortgage interest costs are high, and they're continuing to accelerate on a year-over-year basis. And so the Bank of Canada, is playing a role in some sense in keeping interest rates elevated, and as a result, keeping the shelter component relatively elevated of inflation. And then you look at services less shelter, and we are seeing on that side as well continued sticky prices. And we are optimistic that the bank is going to be able to cool the economy with higher interest rates and ultimately start to bring down some of the drivers of that services ex shelter inflation, such as wages, which are a substantive component of that. So we think that that's going to be the case. We think the Bank of Canada is done, that they have hit their terminal rate, but they will keep rates where they are until they start to see that inflation is headed in a meaningful way back down to that 2% target.
So I'm curious what that ends up meaning for the Canadian dollar, Randall, because as we have seen that sort of divergence happen between the Bank of Canada and the Federal Reserve, when the Bank of Canada decided a pause was probably going to happen, and then a pause happened, and the Federal Reserve, until a week and a half ago, was saying higher for longer. We did see the U.S. dollar strengthen as a result of that, and the Canadian dollar weaken, which also complicates the inflation situation here in this country, right? If you need to be importing U.S. goods, when we're thinking about food prices in particular, trying to get fresh fruit and vegetables at this time of the year, you're having to pay more than that, essentially, because the Canadian dollar is worth less right now. So how does that all play into the situation?
Well, it certainly is on the Bank of Canada's mind when they're deciding interest rate policy relative to the Fed. When you look historically, the Bank of Canada has followed the Fed closely in terms of the hiking cycle, but often there's been ultimately been a spread between where the federal funds rate ends up and where the overnight rate of the Bank of Canada ends up. And so it's not unusual to have some spread between those. The Bank of Canada's analysis suggests that a 10% depreciation in the Canadian dollar adds about 0.3 percentage points to inflation. And that's something that, it pushes up inflation for a year and then kind of starts to run off. And so it's one of those things the Bank of Canada needs to decide between the trade-offs of slightly higher inflation as a result of higher import prices versus the impact on Canadian households, who are highly leveraged by international standards and relative to our U.S. cousins. How much higher they can go and how much more Canadian households can take in terms of the impact on their mortgage costs as well as consumer credit. And so it's really a trade-off that the Bank of Canada needs to make in trying to walk that fine line between tightening too much and not tightening enough and keeping inflation higher than it needs to be for longer than it needs to be.